Hello everyone and welcome to Atomic ACCA's pre-mock exam solving series, and in this video we're going to continue with our section B for AA March 2025 exam. In the previous sections we were solving section A questions and the easy marking areas from section B. So in this video onwards we're going to look at the complicated areas of section B, which is the box question and substantive procedure. So let's move on to our first case study, and we had marked all of our questions over here which are already done. 16, 19 and 20 is done. So let's move to question number 17. That's probably the next one. Where is 17? Question number 17. So the question is asking describe 8 audit risk and explain the auditor's response. So we'll have to find left side, identify and explain. That's going to be half mark and half mark, so that's 1 mark. On the right side, when we are writing a response, we'll get 1 mark over there. So each problem we find, it's going to be 2 marks. So in total 8 problems, that's going to be in total 16 marks worth of question. So let's start finding out. Today's date is 1st July 20x5. Jambo Communication Company is a large mobile phone company which operates a network of stores in countries across Africa. Company's year end is 30th September X5. So 1st July X5, 30th September X5. That's why it's told audit risk is at the planning stage. So year end is still to come. Now you're the audit senior at POA and Company. Okay. Jambo is a new audit client and you're currently planning the audit with audit manager. You have been provided with the following planning notes from audit partner. Following his meeting with the finance director, draft financial statement shows profit before tax of 9.4 million and revenue of 15.1 million. Now, new audit client is a very common detection risk that we have come across during our practice sessions. So that will be our first problem. Jambo is a new audit client and you're planning this one. We can just copy paste, or just that new audit client, that line is enough. We'll just make this a little bigger. Okay. So first problem is Jambo is a new audit client and you're currently planning the audit. This one. What is the problem? Before we read and go through this, we can just finalize this thing so that one problem is sorted. Then we'll go to the next one. One by one, we'll deal it at a time so that we don't have to think of too much information at the same time once we start writing the answers. So with new audit client, what is the problem? POA and Company will not be familiar with the accounting practices, business operations, opening balances of the client company as they are new. Hence, there is a detection risk present here. Done. So we're done with our 1 mark on the left side. In order to make sure that this detection risk doesn't turn out to be a problem, what can auditors do? Auditors or audit team must make sure that sufficient amount of time is spent in understanding the client companies, what all things, accounting practices, operations, companies of business operations, etc. They must uh, plan the audit accordingly and select an appropriate competent audit team for this audit. So that's enough. Understand the client properly, bring a proper audit team. What else can you say? Be skeptical throughout. So audit team must ensure to maintain skepticism throughout the audit. So we're done with 2 marks. Now 1 down, 7 to go. Then during the year, company has spent 2.2 million on developing several new products. Some of these are in the early stages of development while others are nearing completion. Finance director has confirmed that all projects are likely to be successful, and so he is intending to capitalize the full 2.2 million. Now this is our next indicator. Wherever you see a dollar sign, there will be a risk over there. So we saw a dollar sign about 2.2 million. What is this related to? Development product, intangible assets. So we're going to copy paste the idea, and we will company spent 2.2 million and finance director is intending to capitalize the full 2.2 million. So when you're copy pasting, no need to copy paste the entire paragraph as such. Just copy paste the idea, just to show that okay, this is the reference point we are bringing from the case study. Now, what is the problem here? According to IAS 38, expenses that meet the, okay, also be careful. If you don't know IAS 38, just say according to intangible accounting standard or according to IFRS. Don't write the wrong accounting standard. If you're writing it, write the correct one. So according to IAS 38, expenses that meet the development criteria should only be capitalized. The remaining ones should be expensed out. So we told the accounting problem over here. What could be the risk over here? There is a risk that expenses that don't meet the development criteria is also capitalized. Hence, assets may be overstated and expenses may be understated. So left side is okay. What will we write in the right side? How can I ensure that expenses recorded are only capitalized figures, and whatever is revenue expenditure or whatever is the normal, research expense, it's expensed out to SOPL. I can collect a breakdown of this SOFP expenses, check what all are details of that, what kind of invoices these are, have a discussion with the management and understand what is the stage of progress of that particular project, then confirm whether these expenses are meeting the criteria or not. So obtain a breakdown of capitalized expenditures, do a perform a detailed testing over the invoices of each expenditure, discuss with management the stage of completion of the what was it, of the development products, and assess whether the expenses included means in the capitalized expenditures, so expenses included are meeting the IAS 38 development criterias, and those that are not meeting are expensed out to SOPL. So we are done with this particular point as well. So 2 down, 6 more to go. So let's start reading from here. Jambo purchases goods from a supplier in Central Africa, and these goods are shipped to the company's central warehouse. The goods are usually in transit for 2 weeks, and the company currently records the goods when received. Jambo does not undertake a year end inventory count but carries out monthly continuous perpetual inventory counts, and any errors identified are adjusted in the inventory for that particular month. Manufacturers regularly bring out new model of mobile phone. When this happens, the old models have to be sold at a significant discount as customers usually want the latest model. Jambo has number of older models in inventory. Now this whole paragraph is talking about inventory itself. First two sentences were talking about recording the inventory. That is, when they order, it takes 2 weeks to reach over here. Only once it reaches over here, they are recording it. Now, what could be the risk over here? Let's say, what is the year end for this company? Um, Year end is 30th September. So let's say products were ordered somewhere around, let's say, for example, 20th of September. That is 1 week before the year end. Now the purchase is made 1 week before the year end, but since it's taking 2 weeks, product is reaching after the year end. So there is a risk that company always wants to boost their inventory figures because inventory is a current asset. If assets are boosted, automatically liquidity ratios will get better. Also, closing inventory, if it goes up, what will happen? Cost of sales figure, the expenses will go down. So like this and all good things are there if inventory is boosted. So there is a risk that things around the year end figures, company might start boosting it by recording the inventory even before reaching over here. So that could be a risk over here. Second, they told about perpetual inventory count. They're not taking a year end inventory count, rather a monthly perpetual count. It is okay to do so, but what could be a risk? They're telling that if any errors are identified, it is adjusted in the inventory system for that 1 month. Now, if in case through that monthly count, if certain areas of the inventory is missed out or they didn't correctly account for it, then what happens? If any errors are there, this will be missed out for that month, and when you count it next month, this will be automatically omitted. So there is a risk that during the perpetual inventory count, some areas of the inventory can get missed out, because when you repeatedly do this 12 times over the year, humanly nature, you might get bored of doing this, or you might think that okay, this area didn't move much this year, or this particular kind of inventory was not much purchases or sales didn't happen, so probably nothing much happened over there, so let's not count it, let's count the other areas where more movement happened. So what happens? There's a risk that some of the areas within the inventory may get missed out or may not be counted during the inventory count on a monthly basis. So that's the second risk. Third one, they're telling that because manufacturers are regularly bringing out new model of mobile phone, old models have been sold at significant discount, and Jambo company is having, that is client is having lot of old models in their inventory. So this is an indicator that if it's being sold at the discount, NRV of the product could be lower than the cost. And as per IAS 2, inventory is supposed to be valued at lower of cost and NRV. If in case they're not reducing it down to NRV, there is a chance or there is a risk that enough write-off or impairment of inventory is not recorded properly, which can again overstate the inventory, understate the expenses. So there's basically three risks within that paragraph itself. We'll pick out two and write over here, and maybe we'll try finding more risk from the other paragraph related to different topic. Let's not stick around the inventory itself and finish off the quick question so quickly. We'll take two from here, then continue reading and find the remaining ones from the other paragraph. If in case we're not able to find out anything else, then we'll come back to this paragraph and get the information. So first, let's talk about that transit problem. Um, The goods are usually in transit for 2 weeks and company correctly records the goods when received. Oops. Purchases from Central Africa. The goods are purchased from Central Africa and is usually in transit for 2 weeks and company correctly records. Okay. There is a risk that if goods are ordered right before the year end, client may wrongly account for the inventory even before receiving it. Hence, there is a risk that inventory could be overstated. Okay. Now, what can we write on the right side? How do I confirm that inventory is not overstated? I can do one thing. Whatever goods are there in the inventory, like I can take a sample of what inventory that came up right before the year end and right after the year end, then I want to confirm what date were these actually accounted for. So I'm comparing the financial statement. Then I'm also checking the goods dispatch note, meaning when the items were sent from the supplier, they would attach a note with it, goods dispatch note. So I'll collect it and I sign it over here. Okay, goods I received, everything is fine, all proper condition and all. I'll sign and tell them that I got these things. Now I want to compare when is this goods dispatch note coming from the supplier, when are these items recorded within the financial statement. So when I compare this, I'll get an idea whether goods that were not received before the year end have not been accounted for. So I'm going to check sample of invoices, I'm sorry, sample of inventory that came before and after the year end. Check the goods dispatch note and or all these purchase orders and things and all. Purchase order is not going to give me any idea because anyways the time period is 2 weeks. What I want to know is the goods dispatch note, because once it is dispatched, let's say the date is there, goods dispatch notice, let's say uh 30th December, I know 30th September is the year end. So let's say if 25th September is the date written on that, it means that 2 weeks from there it will take to reach over here. So if in case those inventories are recorded, it means they have overstated the inventory. So this is what I'm trying to find from the goods dispatch note. So for a sample of inventory recorded within the financial statements, obtain the inventory accounts, obtain the inventory records of when it was accounted and compare it, not compare, cross verify it with the related goods dispatch notes of those products. Confirm the date of accounting for a sample of inventory recorded within financial statements before and after year end. Obtain the inventory record of when it was accounted and cross verify it with the related GDNs of those products. Confirm the date of accounting and GDN to ensure that inventory that was received post year end have not been included within the inventory records. Okay, so that is over. Next problem we told was that new model phones and some inventory write down is needed. So Jambo has a number of older models inventory, and these are generally sold at discount as customers usually want the latest model. Now, as per IAS 2, inventory is to be recorded at lower of cost and NRV. If products are sold at a discount, this is an indicator that NRV may have fallen, fallen below the cost of products. If these have not been accounted for correctly, there is a risk that inventory may be overstated and write off expenses understated. How do I ensure that whatever inventory is recorded within the financial statement is at the lower of this? What I can do is, cost is anyways there, so I can first ask the management, like for the sample of invoices, give me the purchase invoices so I can get the idea what was the cost they purchased it for. Then what I can look is, for these old model inventory, if they have sold it somewhere around the year end or right after the year end, there will be sales invoices for this. I can collect the sales invoices because that will give me an idea at what price they are selling it to the customer. So I can compare this purchase invoice of that product and the sales invoice of that product and see which one is lower. If this one is lower, that is purchase invoice is lower, everything is okay. If in case NRV is lower, then company should have been recording a write off for that particular product. I'll check in the SOPL whether that expenses have been recorded or not. So this is the idea. So auditors must obtain a sample of old model, old model, what is it, old model inventory, what, mobile phone, okay, must obtain a sample of old model mobile phones purchase invoice to understand the cost of the item. For the same product, collect the sales invoices around year end, preferably post year end, because before year end maybe there are chance that you sold it at exactly the cost or maybe slightly higher than the cost. Maybe right after the year end, if there is any indication that you're selling it at a lower value, then it's an adjusting event. You're supposed to adjust the mobile phone's value to a lower figure. So preferably you need to get the sales invoices post year end. So correct the sales invoices. We'll just make it like this. Sales invoices for the same product, collect the sales invoices post year end if any sales have happened for the items to understand the NRV. Compare the NRV and cost and confirm that inventory is recorded at lower of it, and if NRV is lower than cost, related write-off expenses are recorded in SOPL. And if NRV is lower than cost, confirm that related write-off expenses are recorded in SOPL. Okay, so that is also over. So we told how many points now? 1, 2, 3, 4 done. So 4 down, 4 more to go. Let's go to next paragraph. Jambo's management were disappointed with 20x4 results, and so in 20x5 undertook a number of strategies to improve the trading result. This included the introduction of a generous sales related bonus scheme for their salesperson and a high generous sales related bonus. Now, this is another indicator for audit risk. Whenever something too positive or too negative words are there, this gives us an indication that something could go wrong over here. Generous sales related bonus means how much ever sales are being done, automatically that much amount of bonus will be paid, which means who is this given for salesperson. So salesperson will be given a bonus based on the amount of sales. So there will be motivation to manipulate the sales figures or try taking not so ethical strategies or not so right strategies in order to boost the sales figure so that bonus will be captured. So there are chances that short term manipulations could happen, short term focused things could happen, or some accounting manipulations could be there. So all this is an indicator that things within financial statement could be wrong, especially that sales figure. Revenue could be something going wrong over there. In addition, as market conditions are difficult for their customer, they have extended credit periods given to them. If market conditions are difficult and you're giving extended credit periods, you need to be careful, because if people or customers that are not credit worthy, if you give extended credit periods, there are chances that this might turn into a bad debt. So you might want to discuss about that as well. There's two risks over here, one related to that bad debt, one related to this boosting sales and all. We'll take one from that paragraph for now. We understood there's two risks, but we'll take one from that paragraph now, then we'll move to the next one. So one we'll take is all related to the general sales bonus and also included introduction. Company introduced a generous sales related bonus scheme for the salesperson and high profile advertising campaign. Okay. To boost the company's trading results, a generous sales related bonus scheme for their salesperson and a high profile advertising campaign was introduced. Now, what is the risk over here? There is a risk that in order to improve company profile, accountants or management may try purposefully manipulating the SOPL figures. Moreover, as a generous sales bonus is given, salesperson may undertake unethical or improper sales strategies to boost the revenue. Hence, there is a risk that revenue and profit figures may be overstated. What can I do to confirm this? Specifically, two risks I told over here. One is about SOPL, generally there is a risk, plus revenue, specifically there is a risk. So, connecting to both of this, I need to ensure that these figures are okay. One thing, improved and detailed substantive procedures and evidence collection must happen when testing around improved skepticism and detailed substantive procedures and evidence collection must happen when testing around the SOPL figures, that is income and expenses. Specifically with regards to revenue figures. Now, where are chances of boosting going to happen? Chances are generally related to, for example, post year end. That is, you sold some items right after the year end and you tried including over here. That could be a risk. For these people who are achieving the bonus during the year, we have to little more detailed do a detailed check on how these sales were made, because if they achieved a bonus, that means they hit the target. In order to hit the target, did they do some kind of manipulation, or did they try selling it to, for example, they sold it at a very small value, like a very small discount figure, and they sold many units. So did they do some kind of account, some kind of strategies like that, or was it sold to some related parties at a very high price, and did they record it as a revenue? Maybe let's say if it's a large company and they have a subsidiary of their own, did they sell it to some related party like a subsidiary itself and try boosting the revenue? So all this can be tested. We can write all the procedures over here, so one or two could be enough. So specifically with regards to revenue figure, auditors must obtain sample of sales invoices. Regards to revenue figures, auditors must obtain sample of sales invoices post year end and confirm that these are not recorded within SOPL. Moreover, detailed testing of revenue samples should be conducted for sales achieved by bonus winners who achieved the target, to ensure no unethical practices or accounting manipulation was done for these. Okay, so we're done with that point. So we didn't talk anything about that bad debt part. We'll keep it for later. Let's see the remaining paragraph. So we're done with 5. We need 3 more. During the year, directors have each been paid a significant bonus, and they have included this within wages and salary. Separate disclosure of bonus is required by local legislation. So that is a quite simple point. If disclosures are not made properly, then financial statements are misstated. Because even if IFRS is not requiring to do that, I mean IFRS is requiring to do that, but if a local legislation specifically is saying and that is a requirement, then it is very important. Then client must fulfill that regulation. So that is a easy point. Just keep in mind, whenever anything is asked by the local legislation, that is an audit risk you can talk about. That is, if client is not following that local legislation, financial statement is misstated. So separate disclosure of the bonus for directors is required by local legislation. There is a risk that client company may not have disclosed adequate details about the director's bonus payment, and hence financial statements may be misstated. Now in this case it's about a disclosure requirement, so there is no overstatement or understatement. So don't simply forcefully say that disclosures may be overstated or understated. That's not the case. So just say financial statements would be misstated over here. Now what can I do over here? Now the only thing that problem existing over here is whether they made proper proper disclosures or not. So what I can do is first, talk with the management or review the details of what all kinds of disclosure is needed by the local legislation, then review the disclosure note and confirm that whatever is needed is actually recorded or not. So very straightforward. So discuss with management and obtain the details obtain the details of disclosure requirements by the local legislation. Then what I have to do? Review the disclosure notes and confirm the requirements of local legislation is adequately met. Review the disclosure note and confirm the requirements of local legislation is adequate. Okay. So that is it. So that is over. So we're done with 6. 1, 2, 3, 4, 5, 6. So we need 2 more. During the year, while calculating depreciation, directors extended the useful life of plant and machinery from 3 years to 5 years. When extending life happens, what will happen? Automatically, depreciation expenses recorded will be low. That's already recorded, wrote over here. This reduced the annual depreciation charge. Now, keep in mind, this is another indicator for audit risk. Whenever some accounting policy is being changed, for example, depreciation policy changed, or inventory valuation method changed, or if estimates are changed, for example, you know, provisions are increasing, provisions are decreasing, allowances being recorded less, or warranty provisions are not recorded enough. So if any kind of these estimates changes are there, there also some risk will be there. So policy changes, risk, estimate changes. Keep an eye on this. Some audit risk you can always build out of this. So here the problem is directors extend the useful life of plant and machinery from 3 years to 5 years. So we'll just copy paste this. Directors extended this one to this one. When, as per IA 16, it is required to assess the useful life of the asset at year end. But if the company has purposely increased the useful life, aiming to reduce the annual depreciation charge by considering they have a motive of improving the trading results this year. That means they want to improve their performance this year. So if they're purposefully trying with that motive to reduce the expenses, there is a risk that assets would be overstated and depreciation expenses understated. Why assets overstated? Because less depreciation is being recorded, so assets are big value right now. So this is the problem over here. How do I make sure that whatever is recorded as part of depreciation, or whether this, now it's not about the amount that we are concerned about. It is about the policy or estimation changed from 3 years to 5 years. Is this accurate or not? First thing I can do is I can go talk to the management and ask them, why did you make this change, and understand their rationale behind this, like their mindset behind this. But whatever they say, am I supposed to believe this? No, I will not stop over there. I need more evidences. What can I do? For similar kind of assets in the market, I can check what is their useful life. Or for a competitor, if they have a similar asset, what is their depreciation policy? Or I can call a property valuation expert from outside and bring them in and ask them, for this kind of asset, what could be the useful life for it. So I have multiple ways of understanding what could be the actual useful life of the asset. Then only I am going to trust what the management is saying. So first round of discussing with management is only for namesake. We're not going to actually believe what they're telling completely. So we need more solid evidences to find this. So first thing, for namesake, we'll start talking to them, discuss with management and understand their rationale behind increasing the useful life of the asset. Now for more solid evidences, auditors may contact or may seek help seek help from external property valuation expert and in estimating the accurate useful life of the asset. This much is enough actually. Now if you want to write more, one more sentence you can write is, you can compare with the industry averages. Auditors may also compare with, this is extra, okay, not needed, with industry averages. Auditor may also compare with industry averages on what depreciation rates and useful life is used for a similar asset like that of the client. So we're done with that point. So that is over. 7 down, we have one more to go. So let's move to the last one. Reporting timetable for audit completion of Jambo company is quite short, and the finance director would like to report the results even earlier this year. Finance director means from the client side. They want to report it earlier, and the reporting timetable for audit completion is very short. It means that we are put in a strict timetable over here in order to finish the audit faster. So there is an intimidation problem over here, and if in case I'm doing the work really fast, automatically there is a detection risk over here. I'll not be able to find out the risk properly. Keep in mind what all are the few indications for a detection risk, like short time period, or some kind of intimidation being there, or some pressurizing is there, or new audit client, or if in case they are trying to lure you with lot of money, like audit fees and non-audit fees, if they're trying to bribe you and all. Keep an idea or keep a note of all these different kind of indications for detection risk, because compared to the other risk of material misstatement that's going to be there in the FS, detection risk is quite straightforward to find, and it is very easier to write as well. We won't have to think too much. Like related to new client, there is only one kind of answer that we'll have to write. Related to time pressure, there is only one kind of answer to write. So you don't have to think of accounting standard, you don't have to think of lot of policies and all, or you don't have to be too specific with the case study to figure out what is the issue. So this will be little more easier. So what you can keep in mind for detection risk, what all are the different indicators? Try learning from the materials that you have or from the exam kits that you are solving, and keep a note of all these and see what is to be written in every situation, so that can be your easy scoring area within the audit risk topic. So we will write this final one over here. Reporting timetable for audit completion of Jambo company is quite short. This means audit team would be under a pressure to finish the audit work quickly, and this may cause a increased detection risk as if time not spent well, audit evidences would be missed out. So one mark over here. Right side, what can we say? Simple idea. We can just talk to the management and tell that we need sufficient amount of time to do the audit work. And if in case you want to do the audit really fast, now I cannot back out from the audit because audit firm business it is, and I'm not going to give up that client because that's money for me. So I'm not going to give up that. What I can do, I'm going to find out alternatives. So okay, time is less. What can I do? I can not do it faster than the time limit available, but still we are in the planning stage. So what I can do is I can conduct an interim audit. Then I can conduct a final audit also. So what happens? The pressure around the final audit goes down. I conduct an interim audit, some work is already done. Then later on I can plan for the final audit so that maybe up to whatever limit they wanted, I can finish the work also and I can do my work properly. So I'm not going to reduce the work. Either I'm going to ask for extended timeline or else I'm going to, try hiring more employees, more audit team in order to finish the work. But that's not a suitable safeguard. Let's say my audit team is of only 10 people, and if they are asking a pressurized situation over here to finish it, I cannot bring 100 people and do the audit. That's going to be practically not possible. So I can write it if I want, like in last point, but that's not going to be very valid in this situation. So we have to be little practical also when we give the auditor response. So over here, first thing I'm going to discuss with them and ask for an extended timeline. So discuss with management about the timeline issue and request for extended time period to do the audit procedures properly with best quality. Alternatively, auditors may also the request seek to request from client company to plan for may seek to request from client company to plan for interim audit so that um, final audit work pressure will be comparatively less. Okay, that should be enough. Oh, one more point we told was about hiring more audit team members. Audit team may also consider uh, taking up a larger audit team to audit audit areas at the client on may also consider taking up a larger audit team to cover the audit areas to cover larger audit of large wider views wider audit areas quickly if it is practically possible for the audit team to do so, because for a small audit firm they cannot hire more people, there will be a limitation for that. So we're done with 8 points and we already skipped few points purposefully in between and all in order to try finding different points, which means the idea is if in case there are 8 audit risks being asked in the question, it means there will be more than 8 risk always in the case study. There are students who come up with the uh, you know judgment after the exam that they asked for audit risk for 8 of it. I read the entire case study really thoroughly, but I was able to find only 7. 8 was not there. So that's practically not possible at all. If they're asking for 8, they're not going to put inside the case study less than 8. They're not going to put exactly 8. Rather, they will put more than 8 so that it's easy on you to find out. If not one, the other one you will be able to find out. So this is how we practically do all these audit risk question. Few things, main key takeaways from this question we had was number one, for detection risk, write down few points, what all are the indications and what would be the answer for it. Number two, wherever dollar sign is there, amount is there, We'll be able to find a risk in that. Number three, we told about change in estimates or change in accounting policy. When something is there, there will be a risk in that. Generous sales related bonus, that is another indicator. Whenever two positive or two negative words are there, that will also be an indicator that something is going wrong. So this is how you can crack your audit risk question, and hope you have followed all the way till here. Now we're done with question number 17 for this case study. Next is question number 18 related to substantive procedure. So let's move on to the next question. So the question is related to describe the substantive procedure you should perform to to confirm the director's bonus payment included in financial statement. Director's bonus, we read that somewhere over here. 2-year warranty to its okay, this is warranty. We read about that audit report question. Where is extended useful life? Paid significant bonus. Okay, directors have been paid a significant bonus and they have been included this within wages and salary. Separate disclosure of bonuses required by local legislation. What is the question again? Describe the substantive procedure you should perform, and how much should we find out? We need to find for 4 marks, so we need only 4 procedures over here. And they didn't ask anything specifically about any assertions over here. They just asked to confirm that bonus payment included in financial statement. So two things we'll need to confirm is, one is about the amount, second is about the disclosure specifically. So two things are there, and 4 marks it is, so we need to find 4 points. Number one, let's go with the easier ones. Disclosure we had already talked in the audit risk topic. So either you can copy paste from there and just modify the sentence, or else you can build the point over here in a simpler statement. What is the disclosure? Review the disclosure statements, review the disclosure notes, and confirm that adequate disclosures in accordance with local legislation about bonus, about directors bonus payment is included. So we're done with 1 mark. About disclosures we found out. What else can we do? We can confirm from about the amount. One thing we can confirm is whether the amount was calculated correctly or not. How we can calculate correctly? How will the bonus be calculated? There will be some discussion that happened in the board meeting on how they finalize that. Okay, this is the bonus calculation for directors. So that's like a reference point, like the master data. What you can do is you can collect a sample of directors for whom bonus is calculated, calculate it manually, cross check it with this master data, and confirm that it is in accordance with the policy or not. It's not like, for example, directors are supposed to be paid only $1,000 and they are being paid $5,000. So how did this number come up? So you're comparing the actual figure and seeing whether this is in accordance with policy or not. So obtain the breakdown of bonus payment, obtain a breakdown of bonus payment for directors, cross verify these amounts with the agreed bonus schedule or agreed bonus plan, agreed bonus plan for directors, and confirm the calculations are in accordance with the agreed policies. So that is okay. Next thing, I can see whether the accounting is done correctly or not. That is, now I took a sample of bonus payment for directors. Now I need to see, let's say the calculation over here is stating that 100,000 is to be paid to directors. I want to see 100,000 expense within SOP here also, because if 100,000 is calculated and only 70,000 is recorded, so where is the remaining 30,000? So I need to get a confirmation about the numbers. So obtain a breakdown of bonus payment for directors Cast it means add it, find the total, and confirm that the same amount has been accounted for correctly within the salary and wages. Counted for correctly within the salary and wages in SOPL as an expense. So third one is okay. Now we told about whether this is in accordance with policy or not to figure out calculation is correct. Number two, we check the calculation and connected to the SOPL and check whether the accounting is correct or not. Third thing, calculation is correct, accounting is correct. Was this paid correctly or not? Did this get paid to those directors, or is it still a pending payment? So, how to confirm this? If it is paid already, that means bank transaction is supposed to be there. So, what you can check is you can check the bank transaction. You can take the bank statement and see what is the bank transaction. You can see the payroll record and see who is the director and confirm that first calculation you took, the expense recorded, bank statement transfer being made, whether the amount paid is correct or not, and whether it is paid to the correct director also or not. Now, one more additional point we can just write over here since we made the point already. If in case bank statements it is not there, that means it is not yet paid. If it's not yet paid, it means that it is a liability, company is supposed to clear it. So if they're supposed to clear it, it's supposed to be there in the liability within SOFP. So for amounts that are not paid and not there within the bank transaction, check in the SOFP and confirm that the amount is there as a liability or not. So these are the next 2 points we can make up. 4. For a sample of directors bonus payment, agree the calculations that I found out, then agree the calculation and expense in SOPL to the bank transaction records to confirm the payment. And we're not only checking whether payment is made or not, I want to see whether it's made to the correct account or not. From obtain the bank account details of those directors to whom bonus is to be paid and confirm that the transaction of or that the payment of bonus is made to the correct director's account. So that is done. We told next thing about liability. For payments that are not yet made, means can't find on the, for payments that are not yet made, those not available in the bank transactions, confirm that if these bonus is like meeting targets, right? So it becomes a liability for the company only if these people have met the target. If they have not met the target also, payment will not be made and it will not be there in the bank transaction. At the same time, this will not be a liability either because they didn't meet the target. So first thing is I want to confirm if they met the target or not. If they met the target and if it's not paid, then it's a liability. Okay. So for payments that are not yet made, which means those that are not available in the bank transaction, confirm that if these directors have met the targets and if yes, confirm that these amounts are recorded within the liability of client company. So that will be the final procedure. Question was asking only for 4, but since we went in the flow, I just wrote one more extra point. And with that, we are done with our procedures. Since this is a management decision about giving bonus payment and all, generally around these areas, we can write one common point always, that is about the obtain written representation from the management about adequate disclosures are recorded and all the calculations are done properly and all these things. That can also be one more point you can write as part of the procedures, but I'm not writing it, just letting you know as part of the uh, you know topic. Okay, so obtain written representation reviewing the disclosure note. This is kind of a general point that you can use in most of the procedure cases, but don't try to use it in a repeated manner. Try being little more case specific and finding out in a more practical manner. So hope you have followed all the way till this particular question on how we did the audit risk and the substantive procedure. For case study number 1, I believe audit report is also part of this question. Jambo company, that we were already done with, and the next one is Sound and Company, so that's case study number 2. So we're done with case study number 1 and hope you have followed all the way till here. See you in the next video. Bye bye.